Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is lowering carry costs, refinancing for Winnipeg equipment dealers. If you're carrying high interest floor plan debt, term loans on demo inventory, or patchwork lines of credit, your financing costs can eat into margins. Strategic refinancing can simplify your debt, extend maturities, and cut rates, freeing cash to invest in your lot, your service base, and your bottom line. Here's how to execute it. 1. Audit your debt profile. List every facility: floor plan lines, working capital revolvers, term loans on demo machines and service vehicles, equipment leases and receivables advances. Key metrics: note balances, interest rates, fixed versus floating, maturities, audit or usage fees, and any covenant triggers. Identify debts above prime plus 1% or those maturing in the next 12 months. Cash flow mapping. Chart your monthly interest and principal outlays against expected sales and parts service revenues to spot pinch points. 2. Define your refinancing goals. Lower all-in spread. Target a unified rate of prime plus 0.51% across term debt. Consolidate payments. Replace multiple payment dates with one amortizing facility and, if needed, a small revolver for seasonal stocking. Extend or align terms. Roll short 1 to 2 year notes into a 5-7 year term matching equipment life, reducing rollover risk. Asitarayitin. Improve flexibility. Add an interest-only period or accordion feature to tap backup funds for hot models. 3. Refinancing structures. Single amortizing term loan. Combines term loans, small demo loans, and high-rate lines into one facility, fixed or variable. Negotiable 6 to 12-month interest only, start to smooth the transition. Term plus revolver hybrid. Core term loan for stable, long-lived assets. Floor plan paydowns, demo pieces. Small secured revolver, e.g. is 10% of total exposure, against receivables or inventory for parts and seasonal purchases. Sale leaseback overlay. Monetize fully paid demonstration units or dealer-owned service trucks. Sell and lease back under operating leases at off-balance treatment. Unlock 70-85% of FMV in cash to prepay higher rate lines. Vendor-backed recapture. If you use captive floor plan arms, negotiate early pay credits or recapture programs, folding outstanding into your new lower rate package. 4. Selecting lenders and structuring bids. National captives versus local banks. Compare OEM floor plan captives, major banks, BMO, TD, with equipment specialty desks and regional credit unions for relationship pricing. Non-bank finance houses. Smaller independent lenders can underwrite quickly and layer mezzanine or short-term fill-in lines. Program mix. For large dealers, consider CMHC's green financing for energy-efficient showrooms or EDC's export financing if you ship used units to the US. 5. Negotiation and best practices. Interest-only start. Secure interest-only draws for 6-12 months. Ideal during spring stocking or to pre-fund demo upgrades. Covenant light. Push for borrowing-based tests, inventory, and receivables values over rigid DSCR or EBITDA ratios. Equipment markets can be seasonal. Prepayment rights. Negotiate no penalty prepayments so you can pay down principal with high margin parts or service cash flows. Audit frequency. For revolvers or floor plans, align audit cadence to your busy seasons. Quarterly may suffice if your inventory moves fast. 3 action steps. 1. Compile your debt inventory. Gather statements, note terms, and prepare a one-page summary of balances, rates, maturities, and fees. 2. Model pro forma cash flows. Build a 12-month forecast illustrating savings from refinancing at prime plus 0.75%, including any upfront fees. 3. Solicit and compare. Request term sheets from two banks, one OEM captive and a non-bank financier. Score them on all-in cost, flexibility, and closing timeline. Then choose the mix that delivers the greatest net savings and operational ease. By auditing your obligations, consolidating into a tailored term loan with or without a small revolver, and negotiating covenants that reflect your equipment cycles, Winnipeg dealers can slash carrying costs, streamline servicing, and redeploy cash into growth, whether that's stocking the latest skid steer, expanding service bays, or marketing new lines. I'm Haider Malik. Thanks for listening. Here's to financing your lot smarter and turning lower costs into higher margins.